D is a total dick, and he's trying to pull a scam off on E. The only difference is, in the real world, G's a real gangster. He's the government, he's got the guns, so he makes the rules. I mean, you've probably seen those clickbaity headlines that say, had you invested $10 X number of years ago, you'd have $75 million now. And yeah, that's technically true with hindsight. But the thing is, would you have really held on this long? Would you have sold once it hit $1,000 of Bitcoin, or 10,000 or 20? I mean, it's really difficult to predict, and there's no sense getting caught up in this what if scenario. I think what it really comes down to for me is, these days there's definitely a sense of the fear of missing out on cryptocurrencies, on blockchain, and on this whole new industry, this whole new economy, this whole new whatever you want to describe it as. And like, yeah, I certainly understand that fear of missing out. I mean, you're watching my YouTube channel, a large part of that is probably related to financial independence, about accumulating a large asset base over a short period of time in an unconventional manner. So, cryptocurrencies sound like a no-brainer. I mean, but these days I see a lot of people investing or gambling in cryptocurrencies, and yet they couldn't even describe to you at a basic level why open distributed ledger matters, or even discuss at a high level the accumulation or the congregation of different technologies that creates Bitcoin. And call me old-fashioned if you must, but I have to agree with Warren Buffett on this. I don't want to invest in anything I don't understand. So I've been slowly taking the time to learn about cryptocurrencies, about Bitcoin, and about blockchain. And so I think it makes sense, if you guys are interested in learning along with me, for us to kind of start with blockchain. And before we can even really talk about blockchain, I want to specifically talk to you guys about distributed open ledger. This, when paired with other technologies and bundled into a cryptocurrency like Bitcoin, results in no need of trusted third parties, and that's why a lot of people are calling this the trust revolution in regards to cryptocurrencies, in regards to blockchain. And I don't think this can be stressed enough. This is extremely important, understanding this peer-to-peer nature of an open distributed ledger. So let's talk about it today. All right, so in this example of an open distributed ledger, essentially, actually, you know what? Before we even talk about an open distributed ledger, let's just at a really high level discuss what a ledger is. So a ledger, you know, if you've done grade 11 or grade 12 accounting, you're probably kind of familiar with like a general ledger, which is what we use in accounting for double entry accounting. And essentially a ledger is just a record, a set of records. And so just kind of keep that in mind. We'll break it out here, but let's talk about what an open distributed ledger is and why it's different than the way we kind of use ledgers today. So in this example, we're going to say that G is going to start out with 100 units. It doesn't really matter what it is. You can call it Bitcoins if you want. You can call it altcoins. You can call it blocks. You can call it units. I'm just going to use the term units, nice and generic. So right now our ledger would show G has 100 units. So let's call this kind of our first block. And now, don't get me wrong, I'm going to oversimplify a lot of things. And if you're a hardcore holder, if you're a hardcore cryptography person, if you're a hardcore blockchainer inside the technology, I'm sure that I'm going to get all sorts of things wrong. So jump in the comment section and enlighten us. Ideally enlighten us in a friendly manner rather than a hostile manner. It usually helps you convert people to your side. Anyways, so right now we got G with 100 units. And let's say A performs some sort of action that G determines warrants paying it forward. They want to give A 10 units. So what's going to happen in this very first transaction is G is going to transfer 10 units to A. And now, because our ledger is very simple and G essentially is the only one that's motivated to care and update the ledger at this point, G's just going to confirm with himself pretty much that he's transferred A 10 units. But so now what happens is A has a vested interest in being involved in the ledger himself, simply because he wants to make sure that he's recognized for his 10 units consistently. And now let's say C does G a really big solid and G wants to pay it forward by sending him 90 units. Well, so in this case you can see A now has 10, C has 90. But so what actually happens in order to validate that G has 90 units to give C? C and the other nodes would all validate with each other to confirm that this was the initial case. So essentially C would reach out to A's node as well as G's node and confirm, yes, G did have 90 units, and now we're going to publish it. We're going to publish the fact that C now has those 90 units. So boom, we publish it, we link it together. And so this is kind of how I like to think about the blockchain. It's incremental additions to the data set. And so this right here is actually, consider this our open ledger. So this is open to the entire network, to the entire community. It's published online, and anyone can kind of confirm where things stand. And so this idea of the openness of the ledger is extremely important. Let's say in this scenario, D is a total dick, and he's trying to pull a scam off on E. So what D tries to do is he goes, hey E, I'll transfer you 50 units if you do me the solid. So how does E know if D has those 50 units to give up? Well, he's simply going to reach out to the rest of the network and see what their ledger states. So E reaches out to A, C, and G because they're all different nodes in this network, and he sees, wait, no, D, you actually have 0 units. You have nothing to give me, so I'm not going to do you that solid. So essentially what happens in this case is when E reaches out to A, C, and G to validate D's claim that he has 50 units to give, he's going to see that, nope, this is actually where the record currently stands. So D, you can go f yourself because you're trying to scam me here, bro. So that's kind of a really high level, the idea of this open distributed ledger. And so the reason it's called open is this is open. Anyone can access this and kind of see the state of affairs. It's distributed because it's not held by just one or a few small parties. It's held by anyone that has a vested interest. And now the people that have a vested interest are going to be some of the people that hold these units, that hold these pieces of code, this part of the blockchain. But in addition to that, all sorts of cryptocurrencies and other blockchains have found ways to incentivize miners in order to validate and calculate and confirm these different processes. And that's a whole nother subject matter. We will get into mining and all that, but that's a whole nother beast. This is a big topic. This is going to take you a lot of time to learn, but I really do think you guys should spend the time to learn about cryptocurrencies before you just go off buying Bitcoin, Ethereums, altcoins, and you know, that super fork of whatever your favorite cryptocurrency is. Okay, so now you hopefully have kind of a rough understanding of how an open ledger system works and why it's called an open distributed ledger. Again, it's open simply because this ledger right here, this is published essentially online. Anyone can access it, anyone can confirm the validity of it, and that's kind of that. It's distributed because lots of different parties have access to it. So it's not just held by one central authority, it's not just held by one trusted third party. Instead, it's a peer network where any of these nodes can have access to it and can confirm the validity of it, publish a transaction. Alright, so hopefully you kind of understand how this works. Now let's take a look at how we actually process financial transactions today. So, using these 7 actors again to break out how we actually perform transactions today in a non-blockchain manner and a non-open distributed ledger. In this case, I'm just going to call it a closely held ledger. So the idea here is there's only kind of one central authority. There's only one or a few trusted third parties that keep track of all these records. Otherwise, everything's kind of private and secretly held. So in this case, we're going to assume, start off again, G's got 100 units. So in this example, G is still got 100 units. The only difference is he's a real gangster in this scenario. He's the government. He's got all the guns, so he gets to set the rules. So G's also a busy guy. He's got a lot of things on the go. He's got to fight all these kinds of international wars, other countries' politics. I mean, there's all sorts of things G needs to do. So he needs to just, he can't be in charge of keeping track of these ledgers and all this bullshit. He's got countries to invade. He's got wars to fight. So in this case, G's going to hook his boy B up and set B up to be the one in charge. So in this case, G's going to set up his boy B. We'll just call him Banksy for now. So G sets up Banksy for being the one that holds the ledger. So G grants authority to B to be in charge of the ledger. So in this case, B becomes this trusted third party. And that trust is essentially because G is granting B a monopoly on processing financial transactions. It's essentially exactly what happens today. The government grants certain companies the rights to be financial institutions, to be financial intermediaries, to process financial transactions, and to hold on to financial assets in a fiduciary duty sense. That's a bunch of words. I apologize. Hopefully you'll still follow along. Smash the like button if you're enjoying it so far. But, so G being the straight gangster, he's too busy, so he puts his boy B in charge. So over here, this is our closed ledger. This is our closely held ledger. So only G and B have access to this. So what happens when A still does G that solid and G wants to pay A 10 units? Well, in this case, instead of G and A just sorting it out amongst themselves, G gives B permission to give A those 10 units. So in this case, A has to trust this third party to update the ledger to keep track of everything. And this is kind of what's going on in our current society with digital currencies. So it's actually pretty rare these days that I come over to your place and give you a huge stack of cash. Instead, what happens is we just kind of pass zeros and ones amongst each other, and the banks keep records of who owes what to whom, who has what, all that stuff. So that's essentially what's going to happen here is B is going to update their records, their closely held ledger, to reflect the fact that A now has 10 units. Then again, C goes and does G a really big solid worth 90 units. So again, G's going to tell B to transfer 90 units over to C. So in this case, again, C is going to trust B to do the right thing and transfer over that information. And so you can see this doesn't actually look different, right? It looks pretty much the exact same. So what's the big deal about having this third party or a peer-to-peer network? I mean, why does an open distributed ledger matter at all? I'm glad you asked. That's the point of this video. So let's kind of break it down. So let's say D tries to do that scam again against E. So D's going to try and scam E for 50 units. He's going to say, I'll hook you up with 50 units if you do me this favor. And so in this case, instead of going out to the greater ledger to double check with everyone that this is legit, E's going to reach out to B and say, hey B, is this legit? Do you approve this transaction? And so if B is on the up and up, he's going to say, nope, that's bullshit. D has no credits, no units. Do not proceed with this transaction. It seems like the system's still working, no big deal, right? But the difference here is there's kind of one point of critical failure. We're depending on B, and B being a trusted third party. So again, remember, B's authority is simply granted because of G, because G's straight gangster who's got a gat. But what if, just stick with me for a second, what if B and D are bros from way back when? They both went to Ivy schools together. I mean, they played on the same varsity sports teams. I mean, they're tight, they're bros. And so this is where B could get corrupted, they could get manipulated, or they could just be sloppy with their record keeping and not double check the ledger. There's all sorts of points of critical failure in this system, and it all relies upon B being the only trusted third party. So if when E goes to validate with B about this, hey B, I'll give you, half of the value I'm going to milk E for if you let this transaction proceed. And maybe B, maybe B's on some tough times. Maybe B's got shareholders he needs to impress. Maybe B's just a dick too like D. I don't know. They both went to the same Ivy school and played on the same varsity sports. They could just be dick bros together. And so in that case, this transaction might get approved even though D doesn't have the credits. But the thing is, B could just be borrowing them from C and just not telling C. And again, because B's the central focus, they're the hub, they're the nexus of this whole process, we're all kind of relying on B not to be a total bitch. But there's no guarantee that that's going to happen. And that's essentially why we see all sorts of corruption in our current financial institutions and our governments, is because of this vested interest, because of this beholden nature these trusted third parties have towards the government. And what's worse is there's all sorts of threats that the government could put pressure on B, again, to kind of make things up, to lie, to manipulate, to distort reality in regards to these ledgers. And if you think that it sounds like I'm getting crazy and I need a tinfoil hat, let's just hear me out for a second here. And if you guys remember back to like 2010 to 2013, things were not going well for Cyprus or Greece and their banking institutions. And so what ended up happening was they literally had national banking holidays where banks were closed for multiple days, where you could not go and actually get your currency out of the bank, where the government forced the banks to essentially shut down because they were insolvent, and all kinds of craziness can happen. So in this case, we know now that G is broke, right? G's given up all his units, but he still maybe wants to get F to do him a favor. So what he can do is, since B's the central party, since B's the only trusted third party here, he can get B to manipulate things. He tells B, shut down transactions for a day, and we're going to redistribute what's on the ledgers. And so in this case, you know, G and B essentially collude together in order to manipulate the ledger, and everyone loses 20% of their units because G needs money. So now A has 8. A and C lose money overnight simply because G and B colluded, because B is the only trusted third party. They're holding all of the value, all the ones and zeros, all the currencies at G's behest. And G's the only one with the guns, so G makes the rules. And that's literally kind of how our financial system works these days. And so you can see that when we have just a few trusted third parties, it really opens the system up to manipulation a lot more than when we're doing an open distributed ledger, simply because everyone has access to this. Everyone can double check the calculations, where when this is closed, when this is behind, say, a firewall, we can't confirm what's going on here. We're trusting B to not be a total bitch, but that doesn't always happen. In addition, the alternative is G can just decide to create more units, and everyone else just has to accept the deflation that's going to go on in regards to the inflation. And in addition to that, alternatively, G could decide to just double the amount of units and grant themselves 100 new units again, and just tell B that that's the way it is. And because B wants to continue to be the trusted third party, they're going to go along with it. And because, remember, in real life, B, on every transaction, because they're that trusted third party, they're skimming. They're taking a small percentage or a fee off of all these transactions. So that's how they make their money. That's how they make their living. So they have a vested interest in maintaining their trusted third party status. So whenever G threatens B with losing their trusted third party status, B kind of has to go along with it or risk losing their entire business model. So hopefully that kind of explains to you guys the risks about these closed, closely held ledgers versus these open distributed ledgers. This is why people get so excited about blockchain. It's really going to democratize and open up the freedom of transactions and trust. We're no longer going to have to rely on these beholden third parties that have their own vested interests and their own partners. We're going to be able to have control. And I think that that's what's so powerful about blockchain and about the accumulation of different technologies that create these cryptocurrencies. So, did this make sense? Do I seem like I'm crazy? I'd love if you guys would jump into the comment section down below and share your opinions. Are you currently investing or gambling in cryptocurrencies? How did you come to the conclusion that you're investing in the right cryptocurrency? And what are your thoughts in general about blockchain and open distributed ledgers? I'm really excited to see where this stuff's going to go and where it's going to take us on the magical ride that is the future. But until next time, remember, I'm Matt McKeever. Making money is a team sport. There's more than enough money out there for us to all make it, but if you're not saving it, I mean, like, what's the point, guys? As well, YouTube wants you to check out the videos down below. I'd really love it for you to subscribe. And yeah, I'll see you in the next video. Thanks, guys. Oh, also share this on social media.